what I kind of wanted to bring was sometimes when I get introduced to a new system or a new strategy, like when I was introduced to James's candles and like when I was introduced to Ace's zones, it's really helpful to also get the sort of like 101 perspective of how to even like start using them, because I think at least for me, I would feel like this inherent fear of like, what if I am doing it incorrectly at the start, and therefore really I am sabotaging myself. So I wanted to give this session as sort of a way to take a look at how a dude who just really started grasping these zones a week ago has used these zones this week, and how they work. So the basis of zones, the basic idea, I guess, behind zones is that they are areas that have a brief moment of consolidation, usually at a higher volume, and then a sharp move away from that area. So like right here, you can see it comes down and then there's this little moment of consolidation and it rips away. And the idea is that there are orders left behind by institutions or otherwise. Typically, you're thinking of institutions or toots, as Mello would call them, as opposed to retail traders, but orders left behind nonetheless, so that when price returns to that area, those orders that are waiting there get filled and you get another reaction from that same area. And so you can see that sort of play out up here particularly well, where you have this brief moment of consolidation right after some pretty heavy volume candles, and then it shoots away from that area. And when it returns, those orders theoretically are getting filled as price returns here, and it shoots back away. And then look down here at the run in the morning, you have a buildup of consolidation, price shoots away. It really comes back and taps the very top of this zone, but doesn't go into the zone at all. And then price shoots away. And then when price came back later on, this is where it found its bounce, because nowhere else really touched this zone. One of the important things to consider with zones is that zones are zones for a reason. I don't say that pedantically. What I'd say that to mean is that when something comes and touches this zone at the very top, it may capture some of the orders, or maybe all of the orders were near the top of the zone. It really is going to depend. But in some instances, what you will have is you'll have something come and tap kind of the very threshold of a zone and shoot away and start a move. And then when it comes back, it may go a little deeper into the zone and capture more orders and push away at that time. Zones do not continue ad infinitum. You really kind of have to have an eye for when they've been filled and when they lose their efficacy. So for example, this is the one that I would pull. Like, you can see that at the time that you really come here, like there's really nothing happening with this zone, which is why I stopped it kind of over here, because this was the last time I really saw this zone play a role in anything. You can make the argument for this, but these kind of like this soft push down isn't really a zone like reaction to me. So this would be when I would consider this zone terminated, dead, gone, whatever you want to say. Which is interesting because that zone and this zone are kind of like similar in that they both started at the beginning of this day. So what gives? Why am I still recognizing this zone? Well, I'm recognizing this zone because it may not still be a place where there are orders sitting, but it is functioning as a good line for where price is kind of coming down to and still finding its bounce. So I just went ahead and extended it because it just gave me a look at the continuation that was happening on SPRT from, I guess, after hours into pre-market from the 25th to the 26th. So now I kind of want to do a close-up look at drawing some of these zones intraday, and then I'll talk a little bit about zones from I guess not necessarily intraday. So Ace would tell you that he does not draw zones on the 1 minute. I get that. It's pretty easy, I guess, to screw it up on the 1 minute versus on the 5. I, as always, love the 1 minute, and that's just who I am as a person. Call it a character flaw. But I also think that in the instances of intraday trades, you can see periods of consolidation building up to the move better on the one. That is for me personally. It's not really a take on whether or not that is the way you should do it. But at any rate, so you can see here that what we had was coming from pre-market. Looking at the day prior, we had this zone, which was acting as supply at the time. And it kept rejecting from that zone. Here's where it found its move. And you can see that what happened was it tested this zone several times. What happens when you're testing a zone several times, particularly when you test it pretty deeply, is you are actually soaking up the orders that are in there. So if there are sell orders left in there from toots or otherwise, when you push up into the zone, you are theoretically capturing those orders. And when you come back to it, you're capturing more. And when you come back to it, you're capturing more until ultimately, hopefully, if you're long in this case, there are no more orders or not enough orders still in the zone to prevent you from moving price up through the zone. And so this is what Ace means when he refers to, and I'll show a better example later on, I think, of TCAT. But this is what Ace means when he says that after a zone has been mostly filled or filled, the next push through is like a hot knife through butter. What he means is that after you've filled the zone and soaked up all the sell orders, there's nothing there really, there's no supply really there to stop you from moving through. And so a good volume push will act like a knife through butter. Look how many times this gets rejected. And then finally, once the day starts and you get a good volume push through the day, it just goes straight through. Like this is a 1 minute candle. In the span of 1 minute, it just cuts straight through. Oftentimes, then, what you look for is a retest of the zone. You want to see it use supply and see it now turning to demand. And so I mean, this is a pretty quick turnaround, right? Like this is kind of a slap turnaround more than a calculated entry turnaround, but you want to see it hold as demand. And then you want to see it use that as demand, because theoretically there are shorts in this area who maybe right here, right here, right here, or earlier on started positions in this area and they have not yet taken profits. They are greedy, or they just got in and didn't get the number they wanted and are still short on it. And they have to start covering. And so what do you and I do as longs when we take a position long and price immediately dips, like let's say 15 cents? Don't you have some like voice in your head that says, man, if price would just come back to my starting position, like I would cover, like I would go ahead and sell and just get out break even, because this trade is clearly not what I thought it was. Shorts have the same mentality, which is why you would want to see supply turning demand, is because what you want to see is the shorts that are underwater actually joining you on the long side as price comes back to their starting position, which is somewhat of a strategy that I'll talk about later in my strategy points, which is that I'll use like a James candle that's in the zone as a place to look to actually enter the play of supply turning demand, because wherever that candle is in the midst of the zone, I can trust usually that some shorts have started their position there, and therefore that is the number where they want to get to, as close to as they can for break even. Like a Fox has asked, what candles in particular do you use to draw your zones? Follow up, wicks or no wicks? What candles do I use? I use any candles that are near a big mover candle, and I want to form sort of I do use wicks if it's necessary, and I'll explain what I mean. So in this case, like what I can see near this reaction is that most of the price kind of consolidated in this box, right? So like there are some like there's some wicking and even some body out of this box, but really the vast majority of the price before the big move was contained in this area. And so that's how I look to draw my zones, is I look for where price kind of really sat. And so you can see that this bottom line gets touched 1, 2, almost 3 times. This top line, 1, 2. This body stays inside this line. This body stays inside this line almost 3 times directly here on these wicks. So that is sort of how I draw my zones, is I'm looking for this in this space of consolidation where the vast majority of the trading, where the vast majority of the volume is being traded. And it looks like it's being traded in this little box here. And so you can see that when price kind of returns to the very tiptoe of this box, bang, there it goes. That is not necessarily to say that I am drawing it in some biblically correct way. I'm sure that Ace still probably draws his zones a little bit differently from me. And that's just how it's going to go. Everybody's got their own kind of approach and their own kind of flavor. And so, yeah, no problem. Happy to help. And so what I was saying was I'll typically try to find like reactive red somewhere in the zone. And that is usually where I'll look for my ad. And you can actually see here that that almost works out flawlessly for where I'm looking for my ad. And again, that's because I believe that shorts are starting a position here, whether it's an unfilled order finally getting filled or just shorts finally seeing this as an opportunity to short. Shorts are starting a position here. And therefore, after they start getting underwater, there is some number of them who are operating without hard stops, or their stops haven't been hit, who are saying, okay, shit, I don't like this motion. I don't like this volume coming in and pushing us up. I want to get out. Let's see if I can get back to my entry and just get out as close to break even as possible. And so that, to me, is part of the shtick behind supply turning demand. It is bears rushing to get out as close to their break even as possible to preserve capital. And so here we have a look at both a zone from the day previous on SPRT and a zone from the same day of SPRT, and then a few looks of other zones from the same day of SPRT. And so I just kind of want to talk about them, and then we'll move to TCAT as another just good example of zones. And then I'll come back to SPRT for something that's kind of mind blowing, but at least it was for me. So you can see here that consolidates, gets its move, finally breaks this supply zone, and that supply zone, you want to see it become demand, and it sure does. It comes up here and just immediately launches away, and then you see another push away here. I would probably add a James reactive candle there for Mellow, and we'll talk about that later. But this is sort of the reactive candle sort of shtick, is that he looks for bearish reactive candles, large bearish candles, because to him they're indications of where shorts enter positions. And so what you want to see is when price comes back and pushes towards that level, you want to see it break it in short order, or else you can believe that the sentiment is still short on the play because bears are still in control. This is where they took an entry and they're not underwater yet, so they're just getting ready for the next entry. But
so,
yep,
thank you for that. So I guess my question is, I really like that thought. So if you mark out where that reactive candle is, right, where there's a big push down, so then you're watching this, right? You have your flag drawn. Where would you look to take a position when it's down at the bottom of bottom of the flag before it had that big push up, like that green candle? Would you try to take it there, or would you take it after it pushes through that reactive candle?
Yeah, so it depends on what your strategy is. So for me, I'm a pattern player first. That's what I want to see. I want to see good patterns. And so for me, I'm probably playing the pattern on some level. So I'm going to take an entry here, and really what this line is going to do for me is it's going to inform me like if the play is over. So what I mean is, let's say that you get this bounce. Let's say that you enter perfectly on this candle here, right?
Yep.
Which is rarely going to happen, but let's just live in that world for a second. You perfectly enter on this candle here and price pushes up. And let's say that instead of doing this, it does this again, right? It just kind of starts rejecting from this level again. I'm just going to go ahead and cut the play.
Gotcha. Okay.
Because what I know is that bears entered a large position here. This, as a matter of fact, this would be the second bear ad. This was the first bear ad. This is the second bear ad. And if this gets rejected again, it's going to be the third bear ad. Like they are going to shove price down in a dramatic fashion again.
Okay, so that's more of a, because I'm with you too. I'm more of a pattern player. So, but that you're using that, then it's just more of a guidepost, right? So you're looking at
Exactly.
that as just a sign. I like that. That's really good right there. Because then once it pushed through, you're going, okay, shorts are screwed. So then it can have a lot more, as you see here, explosive up move, because then they have to cover at some point and it's going to push it up
Right.
further.
So exactly. So these shorts are screwed and these
Yep.
shorts are still here. So this would be the next level that you're looking at. And you can see in both instances, I keep deleting this line before we're done talking about it, but you can see in both instances that price gives a dramatic move through the line. I mean, this isn't a dramatic move, but like this candle is big and is the candle that breaks, or it's bigger than relative, and it breaks this line, and then it consolidates over the line and pushes up, and then look, you get a big candle through, it consolidates over this line. Because what are we talking about? We're talking about bears being underwater and wanting to cover as close to their price as possible. And then that's when it gets its next push up.
Would you say that they almost tripled down, because the reactive candle that you just drew, right? The one you said, it's like the second one almost, right?
Yes.
But then there's another one that came in under that too. They came in
Yes.
again, right?
Yeah, so it's sort of like micro and macro structures and
Yeah.
who you kind of assume is adding. So here's what I mean, like, because I said the same thing to James. And what he pointed out was like, yeah, so a lot of times within the genuine bear ads, like from the talented bears, you will also see entries from novice bears. And so like the talented bears are adding here as their first ad, and then you know that they're kind of like waiting for their turn because there's a little bit of covering here from maybe some bears who don't know what they're doing, and maybe some longs who and some entries from longs who think that price can continue going upward. And then the good bears add again, and then maybe you get some novice bears, some amateur bears that are like, oh man, price is going down, I'm in. Like,
And then
and
they get
then
smoked.
you right, and then they get smoked a little bit.
Yeah.
But the idea for these levels is, and I'll talk about with you about why these levels are just a different representation of supply and demand ultimately, because that's what me, Ace, and James kind of really concluded, is that they're a different approach to it,
Awesome.
or a different guidepost to it, which was something that I like thought about when I was first learning James candles, and then started talking to people about it, and they were like, yeah, actually that makes sense. And Ace was like, yeah, that's exactly what they are.
Love
But
it. Thank you. Yeah, that's good. It's good stuff.
but yeah, so realistically, they act as lines and barriers, because you also have to think about, like, especially for toots as bears, like as prices coming back up to their level, what are toots going to do if they're genuinely bearish and they're just going to control it? They're just going to add, right? They're just going to like, they're going to say, okay, fuck you. This is my line. This is where I make money. You've just given me a dip back to this spot so that I have a chance to add. So I'm going to add. And so that's why these are kind of considered battleground areas, is because these bears should be thinking, shit, I might be underwater soon. Am I going to add here to reject price? And so you really get to find out how serious the bears are about keeping price down at this level, because if they're really holding it, they're serious about it. But like if you're breaking through it, then it's kind of like, all right, these guys, whoever these guys are, they don't have a lot of conviction in this. They don't have a lot of conviction in this short trade, or else they would have just added more here. They wouldn't have let me go past it. So now they're covering probably. They're probably underwater, and they're going to think to cover soon.
So good. Thank you for this. This is really good.
Yeah, of course. And so you come up here, you get a sharp move away. You can see that as it returns to this zone, it gets rejected again. So I'm going to go ahead. I wouldn't call this a zone until I see this second rejection. And so then I'm going to draw my zone out. And I'm going to go ahead and delete this line for now. And so what you see is this zone that we've already tested as demand. It comes off of this, comes down, consolidates in this range again, and starts just kind of flirting with this area. At this point, I would say after this, actually, the zone's used up. And so what I'm thinking about here is just this is a line I recognize in conjunction with my trend line that you would have here. And so it's just kind of a way for me to recognize that there is an area here where longs have had faith in the past. I'm not necessarily still viewing it as supply here. So to whatever degree you want to like shorten that to make it make sense for you. If you just want to draw a line from that candle we talked about earlier, you can see what I'm kind of getting at there. This is a line where longs have held a support in that way. And so we play the pattern and we get this push up, a pretty impulsive move altogether. On the 5, it looks more impulsive. And where does price come? Except to this zone right here. And you can see this is where it starts fighting. And it gets a little rejection, a little bit of dip, a little bit of pushback. But look at the volume. These bears are not serious about this. Like this is not like real supply. There's not, you know, you caught some of it here, right? When you came up here. So you soaked some of it here. So you should expect this area to be a little bit easier, but like maybe not this easy, especially considering you want these bears to really care about protecting their position. And you would think that they'd start getting nervous here, and there's just no bearish volume. So you get the nice push through. And now if you do this, like we just said a second ago, these bears who started their position here are now underwater, and they have to really think about what they're going to do. Like, can they force price back down or can they not? And look again at this volume compared to the long volume. Bears are not going to get this back underwater. Not with this volume. It's not going to happen. And so this theoretically would be a great add. And of course, it comes from that reactive candle where bears added their position. You could literally enter on that and just set a stop loss just a little bit below it. And like you could limit order enter on this and set a stop loss just below it, because if they get priced back under this level, then bears are going to take back control of the sentiment. These bears are going to use a volume push to really take back over what's going on here. And you probably don't want to be a part of that anyway. You can wait to re-enter if something goes well. Contrastingly, if bears do this shit, which is just weak ass, like I don't really care, then you can trust that you're about to get a push higher, which is precisely what you get. And so we come up here and we get a nice little move down here and a move down here.
I have a question.
Yep, go for it.
Sorry, Guppy. If you can go back for this.
Yep.
Okay, so I know, correct me if I'm wrong, but I know that Jimmy Momo mentioned that he likes to see the areas test, like, I guess, for the 3rd time. And it just runs. I mean, would that be considered with respect to that zone, like starting when you mark the first reactive candle and how the bears are adding in the first zone, and then it comes back to retest that area on the 2nd time, and bears would probably add on the 2nd, like you said, and it's in that zone, and then the 3rd time where you pointed where you're.
Yeah, he wants to see it break through there.
But yeah, but like 3, like it'd be testing it 3 times though, right? Like the rule 3 or something. Okay,
so,
cool.
Yes.
Thank you.
So James's thought is that, and I think it's the right thought because it's sort of more human psychology based. James's thought is that anybody will double down once, but will they double down twice? And so the idea is that by the 3rd touch, by the 3rd time it's touching, you want to see the break. I actually, in my personal view, I just want to see it on the 2nd one.
Gotcha. Thank you.
So this is the first retest of this area, and this is the 2nd. I don't want to get to the 3rd because typically if you get to the 3rd, by the time you recognize that it's a rejection, it's usually the knife. Like it's usually a knife. So I prefer the 2nd. The 3rd is a little bit too risky for me. James has other abilities with his eyes that allow him to play a little bit closer to the blade in that way. That is not for me. So I want to see it break through on the second. If it doesn't break through on the second test of a line, I am probably out. And just waiting for it to show me that the sentiment is changing.
Thank you.
Yeah, of course. So you get some rejection here, and then you see a big move down that really starts kind of right here after this little rally or whatever. There's kind of the big move down. So I gave this a zone, and you can see it comes back up, tests and rejects. And you could have extended this and kind of seen some interaction with it, but I just went ahead and gave a new zone up there because it made more sense at the time. But when price comes down from this in this day, look where it starts to hesitate, near this zone that we had from earlier in the day. And then when it crosses through that zone and that formerly demand turns supply, it retests and then it starts selling. So what's happening there? Well, it's exactly what we talked about, but in the long position. There are longs that are for some reason still in this play, or maybe they had orders here that they tried to get filled here and they didn't. They were dumb and didn't remove those orders. And now they're underwater and they want to get as close to their entry as they can, so that they can just get out of the trade and get out at break even, as close to break even as they can. And so you get this retest and then a good selling candle. And then you get this nice push up, maybe some shorts taking profits, maybe some longs thinking, oh, we're at this zone. Maybe we can get a nice little push here, maybe a scalp. So some people push back up to this zone, and more people that are trying to get out at break even, and you've got bears who are trying to continue their position here. Because if you think about on the larger scale, you've got big bear ad number 1, big bear ad number 2, big bear ad number 3. So you are seeing bears want to continue pushing price down, and that's precisely what they do through the rest of the day. But what you can see with the zones is that each time it comes to a zone, that is where it has trouble. And you can see that once this zone has been filled, the next push through it is ultimately deadly to it. It cuts right through pretty smoothly, and then comes back down to this zone and tests the upper limit of it, pushes back up, and then ultimately comes back down to this basically untouched zone except for this little wick. And that's where longs ultimately found the rally they were looking for. And you can see that as you came back up to this, what is now a supply zone, it had trouble, but it ultimately fought through and changed it back. And then it had trouble here. And then in pre-market the next day, it pushed through it, found its rally, bang, bang. And so that is sort of the basics of like how an intraday supply and demand plays out. Now I want to show y'all something on TCAT on the same lines that is the reason why you need to pay attention to those kind of like short rallies at the end of a day. And that is because look at what happened to TCAT when it ran. So TCAT started out in this morning, and obviously great pattern play here if you're playing a pattern strategy. This is a great little pattern play to take an entry on. It comes with pretty low risk off levels. Like I think you could really like, if you're entering, probably trying to enter here, you're entering around 730 and you can cut really around like 725, 724, 723. So really low risk. And you can kind of look backwards and get some ideas of where you might be targeting. But more than that, you can get ideas of where there were untouched zones that were left behind from the day previous. I don't know why I still have both these zones. I decided on this one. So finds rejection and consolidation at this zone, and then it claims that zone, and then it gets rejection and consolidation at this zone, claims it, holds it, push. Finds some struggle here. You can see by the wicks it finds a little bit of struggle here, but at this point, like bull momentum is really strong. Claims it, tests it, run. And so what happened with TCAT is actually just it literally just kind of like ran roughshod through 3 zones of bear ads from the day previous. including the high of day from the day previous, and then use those supply zones as demand, and just pushed up continuously. You then see a little hesitation here, and when I saw this hesitation is when I decided that this was a potential zone that was forming before it continued its run. So obviously it then halted up here, which is what this is. So you drew that across, and look what happened. You got a descending wedge down to this area, right back down to demand, and it worked out just perfectly. And one thing that is sort of bonus content for you here, and it's actually not bonus content because I'll talk about it in my strategy, whatever, but check this out. So this is a descending wedge, and really on a higher time frame, it's a big old bull flag. But for here, we'll talk about it as a descending wedge, which is a bullish reversal pattern or a bullish pattern in general, coming down to a demand zone. And if you want to take a real peek, like a real, like kind of cross your eyes and squint them at your RSI, you've got bullish RSI divergence between what is kind of a very ugly inverse head and shoulders, but this price area is about at an equal level, or honestly a little bit higher than this price area, and yet the RSI is stronger here than it is over here. So you've got three very bullish signs for an entry here. And if you're me, you had drawn a line here and said that that was the sort of idyllic ad. And I probably would have just set a stop loss like right below the body of this candle. So this closed at 9:30, so 9:29 is pretty much where I'd probably put mine. And you can see price never came there, shot up. Here is an area where we found rejection. I'm having to change all these colors back to what they were, but they changed to green when they turned to demand for me, and then they never really changed back. So price comes up. This I didn't consider a zone, but what it is a bearish ad area. And so you can see that it fights with that line a little bit. You could also do it on the bigger candle and call that like the reaction area. And so it fights here and then finds another massive push. And so I drew this area, and again, rinse and repeat. You just get a nice fall back down to this area, and you can see the sort of trend that develops out of that, the micro trend that comes out of that. And so that is sort of how I've been applying supply and demand. You can see here in after hours, you get this massive reaction from this area. So you draw that across, and look what happened the next morning. Came up to this area, halted, fought to get back down here because probably bears are going to cover, get as close to their entry as possible. And then that is where it shoots up from. So that is the intraday, and also like the day after, the morning after, in terms of supply and demand. Now, what I want to talk about briefly, and then I'll just kind of open up for sort of general questions, because I think I've probably left some things that you are wondering about. And that's perfectly fine. I intend for that to happen. I'm not perfect on teaching everything the first time through, but what I want to show you all is just something very cool and crazy. It doesn't have to be on the 1 minute, so we're gonna whatever, but check this out. So, and really this zone ended up applying to it too, and I'll show you all what I mean. But like, so look what happened when these came up to these levels. I mean, you have to remember that at this point, SPRT has made the run of a lifetime, honestly. From like $7, you're up in the 30s, and then it's suddenly like rejecting and acting pretty erratic at this area. And when it was acting really erratic at this area, I was really curious. So I popped out to the daily, and sorry, TradingView, the one thing that I don't like about it is it keeps the lines up. So like you can see that. But so you may be wondering, Gov, where was that zone in the 30s that this thing then launched to the $60 from? Well, my friends, look no further than September 29th of 2004. I don't know that this is actually like a functional occurrence of a zone, or if this is like bears, shorts, and longs all seeing this zone when they scroll back on the chart and deciding that that is an area to potentially short and like all of that. But literally this price had never come anywhere close to $30 until way back in 2004 when it gapped down all the way to $20. And so I just went ahead and drew a zone when that shit was consolidating in after hours and like having trouble with that area, because I saw it having trouble with that area, and there was only one place that I could really like pinpoint and say, well, it could be from here. And it turns out that breaking a zone from 2004 can be a heavily profitable undertaking, because this thing ripped in pre-market from $30 to like $56, and then it came back, retested, and I mean, this doesn't look like a big move, but it's from 31 to $42. And then it comes back and does it again from 31 all the way to $60. So the power of zones really is just sort of interesting. Again, I can't say that this was actually a zone functioning as a zone. Like I don't know that there were orders left here from 2004. That seems a little bit outlandish to me. But what it could have been was a bunch of people recognizing that the last time price was here was back then, and therefore they saw it as a good short opportunity, and then longs were just hyphy and got through that, and shorts got underwater and had to cover, and it got insane for a while there. But kind of a very cool experience just to see that. Also, this zone where it ultimately had trouble is also from 2004. So this is also from 2004. And you saw that I drew it on the lines back in 2004, and you can see that kind of like, you know, it's kind of creepy. It kind of gets respect to a pretty heavy degree on both like the top side and the bottom side of the zone. So all right. Hopefully I've done a decent job describing my application and my beginner's approach to supply and demand and what I expect to see and what I kind of want to see. There will also be a little bit of talk about how I play it when I start talking strategy. But does anybody have any lingering questions about supply and demand for a beginner? The beginner's guide. Speak now. Forever hold your peace. Or hold your peace until later. It doesn't matter. I'll always answer the question. I see some people typing, so we'll wait. Oh, you could talk too. You don't have to type. You're not beneath me. You can talk all the time.
Gup, is there any way that you can go and maybe check out BBIG for a similar pattern when SPRT came out of that descending wedge and actually pushed up through the zones? I kind of wonder if oh, you're already there, huh? Yeah, man.
Yeah, this got wild. Forget when this zone's from. Well, it's from one of these. Yeah. Let's see. Shall we check Zella or Root for a move on Monday? AFRM is another one move postmark on Friday. Yeah, I'm going to save that message, learning to invest, and I will do that at the end of all the session today, so that I can get through the session and then answer like ticker questions. Raf A, who has changed his name because I recognize the AVI, but apologies if it was mentioned before. What is the difference between supply, demand, and support resistance? Great question. There is a very big difference. So supply and demand is focused on first of all, the very basis of supply and demand is that it is the idea that there are orders left behind in an area or a zone by institutions or by institutions or retail traders. But the basic idea there is that when you come back to that area, those orders are being filled, and that is what causes the area to be reactive and act as an area of support or an area of resistance. Whereas support and resistance at its, you could draw a million supports and resistances on this chart. And some of them will be around these like high reactive areas. Many of them will not. Like there will be some support and resistances that just aren't really near any of the high reaction zones. Like you could draw this as a resistance and you can see that it holds as support later, but that doesn't make it a zone of supply and demand. Support and resistance is more focused on prices where longs or shorts have routinely found positive entries. So like when you think of everything is an agreement to buy or sell a given security or a given stock. And so support and resistance is a really kind of, I guess, basic way to see at what price buyers are always willing to enter in and buy a stock, at what price they're sometimes willing to enter in and buy a stock, et cetera, et cetera. And so you're playing off the psychology of other buyers and saying, well, this stock came back to $12.70 and buyers have bought it there pretty much twice before and 3 times before. So I guess, I could probably buy it here. And it seems like other buyers would be with me because they've done that over and over again. Whereas a supply and demand zone is based on orders that are actually placed and still in place that are waiting to be filled. And they act as areas of support and resistance for that reason. But the real idea is that whenever you're pushing through them, either positively or negatively, I tend to talk about pushing through positively just because that's my perspective right now. What happens is, when you rip through a supply zone, essentially what you're saying is there are still some orders there from shorts, but it doesn't matter because you've got so much buying power that you rip through those orders, but those orders still get filled. So you've captured a fresh new bunch of shorts as you've rushed through this with buying. They've sold to you, but you've already put them underwater, and now they have to cover. And so it's a different sort of dynamic than what happens with support and resistance, because support and resistance isn't typically based on like orders that are still waiting there. Gup, are you taking larger positions in the demand zones and smaller positions playing micro trend in between zones? Fascinating question. So right now I just have a standard position size because I play very small right now. I just take 10 shares of anything I take. So whatever I'm playing, I take 10 shares. Theoretically though, what would I do? Like when I'm larger scale and that sort of thing? Yeah, absolutely. That's the right idea. I would be taking smaller positions when I'm playing in microtrends between zones, and I would probably be taking larger positions on positive reversal signals off of like demand zones, for example. I'd probably feel more comfortable. But some of that is very much to be expected, because obviously a zone is another layer of confluence with being willing to enter a trade. Like it's another positive sign. Okay, yeah, no problem, Raf. Richard the Red, what role does volume play when drawing a zone? The volume leading up to the zone is typically pretty important, but it's all relative. So like, for example, this volume in pre-market looks insignificant to this volume as the market starts. But if the volume in pre-market is high for pre-market volume before a zone, then I'm fine drawing it, or after hours for that matter, then I'm fine drawing a zone from there. But the volume is important. It's really important because the volume is telling you how many people are in this area, like to be the supply or demand later on. So you want to see a good volume consolidation before the rip. You want to see solid volume on the consolidation period before the rip. Typically, not typically, I should say, that is the basis of supply and demand. So you always want to see good volume in the consolidation before the rip. It's very important because otherwise there aren't longs or shorts trapped in the area, which is obviously the whole kind of game here. So Can one identify pump and dump stocks from the zones? Thanks. That might be an advanced question for Ace. I actually can't tell you yes or no to that. It would be irresponsible of me to try and speculate. I think you can identify pump and dump stocks from, if you're wondering if something's a pump and dump on a given day, just go on Twitter, type in the ticker and look for posts from chronic offenders on Twitter on the day that it ran. And that will give you a very quick idea of if it was a pump and dump at that time. As far as spotting pump and dumps in price action, I'm not that good yet. There are people who can. I think Ace can. I think Callum can. Like probably Brad and Walrus and all of them can see a pump and dump in the price action, but I absolutely cannot. So I'm sorry that I can't give a better answer on that, but that's what I got for you. All right, I'm making sure this last person isn't a question for supply and demand. I see Lotus typing, and they are in the call right now, so I assume this could be a question, and then we'll move on to strategy. Thanks for joining me this morning, guys, by the way. It's a lot of fun. It's very quiet.
Thanks for doing this.
Of course.
Chicks was really good at spotting pump and dumps. And by the chart, I can spot them too easily, and I can maybe ask Jix if he want to show someone or do a session on it. Should someone be interested?
I'm sure he would.
Yep, you're doing awesome, by the way, too, man. I'm loving every minute of it. Hey, when I'm quiet, you know something's going right.
Thanks, man.
Yeah, I'm paying it for sure.
I can't tell if Lotus still has a question.
You get me and Bianca to be quiet. It's something's going on, ain't it, B?
Facts.
Well, they are no longer typing, so I will assume that question died. And well, maybe they're trying to talk, but we can't hear them because I see their light turning green, but we can't hear you, which is unfortunate.
Lotus, do you have your settings to push to talk, friend, or you trying
the light's turning? Well, the light's turning on, so they would be pushing it. It's just their mic may not be working. All right, I'm eating a donut, so give me just a second. Okay, so now let's just talk strategies. Some of this will be looking at charts. Most of it is really just kind of, I wanted to talk about developing strategies and why I think that's a fearful thought for new traders, because it was certainly a fearful thought for me. And kind of why you don't need to psych yourself out about what it means to have a strategy. So what I mean is, a lot of people will talk about their strategies. And when I heard the word strategy, especially starting out, I thought of something really complicated, something really like complex, and it has a million different things and all your favorite indicators and blah, 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 blah. Like every strategy had to have all this stuff in it. And that's just not true. It has proven not true over and over again. And so what I mean is, like, if you talk to Ace will tell you that he is primarily a supply and demand trader. That is his thing. Zones are his thing. And he recognizes patterns and he recognizes these other things. He knows volume price analysis. That's something that we should all know, because it's something that's sort of the basis of being able to trade effectively. But as far as building a strategy outside of those raw fundamentals that we should all have in terms of like very basic, I don't think you need to be the greatest chartist in the world. Shock and all that I would say that, but I don't think you need to be the greatest chartist in the world, to build a strategy for you that is effective. And I don't think you need a million indicators, and I don't think you need some amazing understanding of supply and demand or reactionary candles or whatever it may be. Like, because all of these things that I'm talking about are in themselves the basis of some trader's strategy out there. Some trader out there, Emu, for example. Emu is a fibs trader. That man works fibs like nobody's business. It is the basis of his strategy. And that is where a lot of his strategy is housed, is in his ability to use fibs effectively and enter and exit plays and set his risk reward from fibs. Broda and Jixer talk a lot about patterns. That's their thing. Technical analysis via the patterns. Things like seeing this triangle or this wedge, whatever you want to call this, and playing the entry off the bottom trend line and playing for a breakout. Ace uses zones, looking at things when they reach supply and seeing how they react, seeing if they start to form a head and shoulders or just react heavily away from the zone and then entering short, or when they reach demand and seeing if they form a bullish reversal like an inverse head and shoulders and playing up. All of these things can be in isolation a trading strategy. You don't need to be feeling like, man, Gup's chart right here that's in front of me is loaded with zones and James lines and patterns and RSI and this, that, the other, whatever. Yeah, this chart is chock full of that. That is because I've spent time preparing this chart to do this session for you, and it is an all kind of access session. I am talking a little bit about strategies of patterns. I am talking a little bit about supply and demand. I am talking a little bit about James candles, and how those things apply. But that shouldn't convince you that Gup has one strategy and that strategy involves all of these things. And if that's what it takes to build one strategy, what is it going to take for me to build 2 strategies, 3 strategies, 5 strategies, like whatever? That's not how it goes. All of my trades are not based on all of these things. They are usually based off one of these things or 2 of these things or sometimes 3 of these things in conjunction. But there is such a thing as just the pattern. You could just play this as a pattern strategy and set a fine risk reward and either come out with a win or a loss of a fine proportion based on your risk reward, just based on pattern recognition. You could do the same thing if you took the pattern away based on supply and demand. You could sit here and say, oh, well, like, I want to enter here and set my risk probably like below this, or maybe like, just at the top of the zone, whatever you want to do. And I'm hoping to get back up here. Like, you could do it just off the zone. You don't have to do a million things. Now, there is such a thing as confluence. It's something we talk about a lot, multiple things telling you the same thing. So inherently, if you recognize patterns and you recognize zones and you recognize RSI divergence and you recognize this, that, and the other, you can build a framework for being able to quickly analyze and realize opportunity based on many things you're seeing. I'm not saying that it isn't more effective to recognize many positive signs at once. It obviously is. But what I want to sort of accentuate off the cuff is that you don't need to have all of these things to get started. You don't need to be the greatest pattern player in the world to get started. You can find your niche in something else and build on that. And it's sort of like how Callum talks about, like, you don't have to play the top gainers. You can play the quieter tickers. Like, is it easier to play the top gainers, like in terms of like finding those ones because they're obviously high up on the list and right there in front of your face? Like, yeah, it is, because they're high up on the list and right there in front of your face. But that's not the only way to play. it's not the only place to find that you can make money. And it's the same way with each individual strategy of patterns and zones and lines and support resistance and RSI and volume profile and whatever, you know, stochastic and all of these other oscillators that people use. I don't even know what stochastic is, but some of y'all might. And if that is something that works really effectively for you, then use it. Like, that can be the basis of your strategy. That can be your strategy. And so what I wanted to talk about a little bit was like a strategy that I've been noticing a lot recently that legitimately I applied because it's just been working a lot. Like there was nothing fancy about it. And there really is nothing super fancy about it. I'm going to try to find like the perfect example of it, so that I can just make the point. But so I believe, actually, I should have been on the 1 minute this whole time and I probably would have seen it already. Sorry, mic not working. Okay. So I am going to get to those questions right after I cover this, I promise. So for example, here's a strategy that has been working a crap ton, like bar none. I'm telling you, this is 100% of the strategy. Yep, RSI divergence is coming at you in 2 seconds, Fox. So this strategy is part of what I showed y'all on TCAT, and it is literally a strategy that I have made money on. I think every time except once. I think I've been green on every trade that I've done this the past couple weeks, because this keeps happening. Price will inevitably run up. Normally it runs up in the morning. Like TCAT had this freakish morning, so this is a little bit interesting that's happening more whatever. But typically it's with these tickers that just run up in the morning and then immediately start doing their deep dive. Ultimately what happens is they end up forming a descending wedge. And at the bottom of that wedge, they start to make an inverse head and shoulders. And what you will notice with the right shoulder is always that on the RSI, there is divergence. There's positive. Oh my God. Why is this doing this? There are some things about TradingView that make me have a disdain for it. But anyway, like, I don't know what this little bar is. I want it to go away. Okay. Well, that's not the button for it. Anyway. So what you will notice is that the lows here are actually higher than the lows here on the RSI, even though this price is lower than this price. That is bullish RSI divergence. And that is showing you that there's actually stronger momentum in the stock here than there is here, which shouldn't make sense if price is lower here than it is here. But so it is. And that's what we call bullish RSI divergence. This has happened so many times in the past 2 weeks. Descending wedge, down to an inverse head and shoulders, bullish RSI divergence, and sometimes it's even over a demand zone. And when it's over a demand zone, that's just the more the merrier. Like, sure, great. And it just plays up, like it just does. Like, there's so much confluence with what's going on. Look at this. So this one, descending wedge, double bottom, but look at the RSI. These price levels are pretty much at the same level, and yet the RSI is higher over here. So you can just buy in and bang. There you go. We'll move. It's nothing dramatic, because August is still August. But I mean, from 517 to 534, like, sure, fine. Small little play. Nothing has to be flashy. Nothing has to be great. Not every play has to be some massive home run or whatever it might be. See, I think Zom also had an example. Yep, there it is. So
Yep.
if you look at Zom, check it out. Descending wedge, inverse head and shoulders. Look at the right shoulder on the RSI versus the left shoulder on the RSI. Right shoulder's higher. And so buy in right here, 70 cents, bang, all the way to basically 74 cents. Every penny under $1 is worth more than 1%. So this is actually like a 5 or 6% play in the span of like ultimately 5 minutes. Nice little 5-6% play off this. That is a strategy. Like it it just is. And if you wanted to take all the bells and whistles off of it and just say that you played the descending wedge, that's a strategy. If you want to take all the bells and whistles off it and say you played the inverse head and shoulders, that's a strategy. If you want to take all the patterns off of it and say that you saw it come down to demand and you decide to buy in at the bottom of the demand zone and set your risk just below it, that's a strategy. Like all of these things in isolation are strategies. You do not need to be intimidated by feeling like every strategy that you develop has to be some mastermind strategy. Check this out. This isn't even a descending wedge. This is just an inverse head and shoulders. You'd see it more cleanly on the 5, but what you see more cleanly on the 1 is the massive bullish divergence between the right shoulder and the left shoulder. And you would get a play up from 68 up to 72. Again, probably like a 5-6% play. Just easy peasy. And it came down to a demand zone on the head. So I mean, quite frankly, I'm looking at this as playing off the shoulder. If you were just a supply and demand player, you'd probably get a better play because you'd see this coming down to demand. You'd see it kind of bouncing around. You'd see this divergence where these are basically at the same price level, but the RSI actually gets a little bit higher here, and you might enter at 67 and get the whole move up to 72, which is better than me getting it at 68 and getting up to 72. Again, it's probably a 1 or 2% difference, even though it's only 1 penny. Like, and if you came down here, like, as a matter of fact, I don't know why I don't have this one labeled. Like, look at this. Look at the right shoulder here, and look at the left shoulder here on the RSI, and look at the right shoulder. Massive divergence. You can just play right off top of the James candle, 66 up to like 70. Again, 5-6% play just off of pattern recognition and RSI. But you could do it just off pattern recognition, inverse head and shoulders. You could do it just off RSI divergence. Like, there are so many ways to create very basic, repeatable, consistent strategies that do not require you to be a masterful technician. Having all of the different tools in your tool belt is a pathway to getting more consistency in finding winners because you will recognize more things. But you shouldn't be afraid to build initial strategies off of what you are familiar with and off of what works for you initially, and add to that as you learn. Because the psychology of trading ultimately ends up being the biggest portion. None of what you recognize or do, or the patterns and the RSI and all of this, none of it matters if you can't get yourself to get into a trade. None of it matters if you can't trust your own conviction and trust your own strategies when it comes down to it. So while you're building up to learning all of these things, if you want to learn all these things, you don't have to, because obviously we've already covered that there are traders in here who really trade off 1 or 2 key strategies. Like, there really are. But if you are interested in learning all of these things, don't forsake the psychological aspect of learning because you feel like you have to have all these things to build up your strategies. That's not the case. You can build very basic strategies based off of a familiarity with 1 or 2 key premises. And so that's really what I want to talk about. Now I'll answer these questions for people. Gut, for the zones, how one can make them fast on live trading day. You showed it as an example where zones are already made. Yeah, so I mean, for example, like if you're in middle of the live trading day and you're trying to slap down a zone, you're just looking for these reactive areas. And so, like, for me, like when you were drawing this, I saw that there was a little bit of consolidation and then a rip. And so all I did was you just come in and decide where your zone is and make a line. And as price comes back to it, you can get a better idea of maybe how it firms up. But like, some of it is just familiarity with drawing the zones. Like I said, I've been drawing these zones for a week now, but they've been my focus for the week. Like, I've just spent all week finding these areas, drawing them, and getting them done. For something like SPRT, when you realize that it's beyond its kind of beyond its gills, I guess, whatever the saying there is, and it's starting to go to like new highs that it hasn't been to in a long time, you really do have to pop out to the daily and start looking for like where the last reaction was. So for example, like I bet that if we went in this wick here and drew it across and looked for stuff, that there would be something that intersects with it, because we see that play out on the daily chart. But if you go here, so we pop down to the hourly to kind of firm it up. I'm actually okay with just this drawing as is on the hourly. So then I'm going to go to the 15-minute, and I'm going to go back like this. Whoop. Just a little adjustment is all I need to make here, like that. And then I'll go to the 5-minute and see if it'll let me scroll back that far. Sometimes it will, sometimes it won't. You can see it won't, so we'll try the 10 just to get a little bit closer if we can. Yeah, ooh, just at the end of my 10-minute, huh? So we know it's not going to get any lower. Whoop. Let's firm this up a little bit. Yep. Went like that. All right, and then we'll go to the 5 and we'll see what happened. So you can see that price, when it was coming to this area beforehand, this is kind of where it had trouble, and it stayed below it. Claimed it, but then still had trouble with the area. Stayed below it, and then when it finally got above it, that is where this run kind of well and truly began. And so like for something like that, where I do genuinely have to pop out to the daily because the thing is a fresh runner, that is how I do it. I go from the daily to the hourly to the 15-minute to the 5-minute, and then ultimately to the 1. Obviously, sometimes I can't go that far back on the 1-minute, and so I just have to deal with that 5-minute zone as my approximation, the same way that here we're dealing with a 10-minute zone as our approximation, because I can't go that far back in time on the 5. And so sometimes I have to use it like that. But yeah, if it's a fresh runner, I have to do that daily to hour to 15 to 5-minute. If it ran the day prior, typically I just look for the zones from the day prior, which is what we showed on that day on TCAT, right here, where it made its big move. What it was really doing was just clearing zones from the day previous. And so you can use the day prior to sort of build up a framework and a structure for that. Let's see. Sorry, mic's not working. No problem, Lotus. I'm sorry your mic's not working. In order for this to be effective, does it need high volume? Since using this, you don't use EMA and SMAs. Yeah, it doesn't need high volume, but it needs good volume in the sort of consolidation leading up to the rip. But good volume is also relative. So like again, like pre-market volume is not going to be the same as volume during market hours, obviously. But if pre-market is seeing a lot of action and has a lot of good volume for pre-market, and you get a reaction out of it, I will treat that as a zone. Since using this, I don't use EMAs and SMAs. I have them turned off right now. I do still use the 50 and the 200. I have abandoned the 9 and the 20. But that's because a lot of the strategies that we're running on the 9 and the 20, I'm just no good at. They just don't fit with my style. And they work for a lot of people, and for some reason they just psych me out. So I just went ahead and removed them for now, and I'll revisit them if I get to a point where I think that like I can use them effectively, but they were doing me more harm than good. So I removed the 9 and the 20 for myself, not because they're not useful. I still use the 50 and the 200 to kind of tell me when we're in bullish or bearish sentiments. Can you show another example of RSI divergence? Yeah, we did that. So I hope I gave you good examples of RSI divergence, Fox.
I have a question when you're done answering everybody else's.
Yes, absolutely. Caden, you have a question. What you got?
Go ahead and answer learning to invest question. Mine isn't even really a question. I just think it's something that you should go over because it really helped me.
Yeah, okay. Okay, RSI, why does it differ when you are on the 1 minute and on the daily chart? It is different. Thanks. I'm looking GRWG RSI on the daily chart is 34 and on the 1 minute closes near 40. Which one is more important? So learning to invest, it depends on what you're trading. I'll switch over to this just to make. So it depends on what you're trading, because the momentum in a stock on the daily is going to be different in the context of the daily than the momentum of a stock on the 1 minute in the context of intraday trading. So like when you are looking to swing trade, for example, which is typically when you're dealing with the daily charts and the weekly charts and stuff, well and truly, is when you're going to pay more attention to what the RSI is on the daily, because at that point you're trying to capture what's going on in the framework of the daily and the weekly and those longer timelines, because you're planning to swing over a course of sometimes a few days, sometimes a couple weeks, sometimes a couple months, or if you're mellow, sometimes years. Like it just kind of depends on what style of trading you're trying to enter. Neither of them is quote unquote more important, except in the framework of what kind of trading you're doing. If you're doing swing trading over several days, the daily RSI is going to be more important to that. If something is running during the day, it's a day trade and it's got a lot of momentum, then the 1 minute is going to be more important, because that's, or not necessarily, I mean, not the 1 minute, the 1 minute and the 5 minute and whatever intraday timers you look at are going to be more important. But like you can see on GRWG, for example, that like this isn't like a day trade. This isn't like a momentum day trade. This is like pretty sporadic price action and kind of gappy and things like that. This isn't like what we've been looking at where these were the runners for the week. And so when you're looking at the runners for the week and you're trying to day trade, you want to look at those intraday. You want to look at those intraday time frames, the 5 minute, the 1 minute, the 10 minute, whatever it is. And you want to give credence to their RSI. Whereas if you're swing trading and doing more long-term trading, you want to look at the daily RSI. Callum, damn Guppy, removing the 9, that's against the law. Yes, it is. It is against the law in a court of law. I can be arrested for not using the 9 for sure. Caden wants me to go to Neuro.
Yeah.
I have it on the list.
Gotcha. Okay, so I actually just got here. I got off work, but I'm not sure if you have talked about this yet, and it's something that really helped me. I kind of tagged you yesterday or Friday, and talked about, and I told people if they want me to explain supply turn demand to them, I will. But I don't think you understand how many like videos I've seen without anybody explaining why supply turns demand. And I actually learned that from you. And I mentioned it was when you didn't even use it, and somehow you knew it and I didn't. So it's like, I think you should definitely explain it to me, because like, just the seeing the story behind the chart is like one of the biggest things, I think, and like that is an extremely important concept.
Here it is. Yeah. So I mean, like, so we talked about this a little bit earlier, but the basis of supply turning demand is that essentially what supply really is are orders left behind theoretically by bears or institutions to buy or sell the given stock at a certain price. And they are also typically at levels where bears have taken hard entries in a stock. So obviously, like you see here at the top here, this was a pretty big flush. Bears kind of entered this and sort of flushed it. And so bears have taken an entry in this place, and there are probably orders left behind. I mean, the theory behind supply and demand is that there are orders left behind by institutions or otherwise to buy or sell. And so what happens when supply turns demand is you end up ripping through the supply, soaking up those sell orders, which means that you've got a bunch of bears who entered here and who did not take profits yet. And you've got bears whose orders you just captured on your way through. And so as price comes back to that zone after ripping through it, these bears who are now underwater want to cover their position as close to take profits as possible, or not take profits, as close to break even as possible, because they want to get out of the trade and they don't want to be more red than they need to be. They just want to preserve capital as best they can because they recognize that the momentum has gone against them and the trade has gone against them. And so as theoretically, as you rip through supply and it comes back, you want to see it retest its demand because those bears are joining you on the long side, quote unquote, because they are buying shares to cover their positions. And therefore, price settles here. And then bulls recognize that they still have control and they push price higher. And so supply turns to demand because the bears have lost and they join your side to help price go higher because they have to cover their positions. It's the same way when demand becomes supply. Longs will have taken a position and then they'll be underwater. And now they're thinking, man, if I could just get out at my entry price, I'd get out so that I can go break even in what is otherwise a bad trade, which is the wrong mentality anyway. They should have stop losses and they shouldn't be involved in that. But for the ones who don't have stop losses and have the wrong mentality, they wait for price to come back up and test that demand zone or that supply zone now, and they cover because they want to get out as close to their entry as possible. Callum says, hence why the second half of the dollar normally flies more on a break as people naturally cover more over 50. Yes. Yes, ultimately all trading boils down to supply and demand, and bears needing to cover their positions and bulls needing to cover their positions, etc., etc., etc. Aldo the Apache, I caught the tail end of your explanation of James' reactionary candles. Could you maybe give another example of these, please? Oh boy. Yes. So James' reactionary candles, the way he thinks of them, and I can do like a one-on-one session on these because I don't want to totally derail us. But James's reactionary candles are based on where bears are adding their position. And so what he looks for when you're looking to go long is he looks for high reaction bearish candles, which are these big bearish candles. They're relative size candles, which is the way the stock normally trades, these small boys. And then there are reactive candles like this big red and this big green and even this red and like this red and like, this green and all that. Those are the reaction candles. So when he's looking to go long, he's paying attention to the bearish reaction candles like this because these are areas where bears added large positions. So bears really shorted this shit here. So what do you think is going to happen when you come back to that position? Well, one of two things is going to happen. Either these bears are going to be like, ooh, great, I get a dip now and I can short some more and add some more short shares and take this thing even lower and make more profit. Or if they're novice bears or if they're just losing the battle, they, as you come closer to this position, are thinking, oh shit, oh shit, oh shit, I'm fixing to go from green to red on this trade. And so they will either add to their position or they will start going red. And as they start going red, these bears are under pressure to cover if they cannot get price lower. So like you can see this hammer right before we go into after hours, it had pretty good volume, but it could not push price back below this starting area for bears. So these bears are officially trapped and panicking about the fact that they are trapped and they want to cover their positions because they don't want to be any more underwater than necessary. So they start buying shares to cover their positions, and ultimately you get a push out of it. And so the basis of James' reaction system is paying attention to those candles because they are where bears are adding large positions, and therefore theoretically those lines should act as key areas, key battleground areas for bears and bulls. And we can do like a one-on-one at some point for more detailed kind of talk of like how I use those in my strategies. One of them is like when I'm doing this inverse head and shoulders positive RSI strategy. So I actually would have been looking like down here at this entry, because look at the sharp change in RSI. Like RSI over here is really low and it's way high right here. And what I can show you is like, this is how I would be finding my entry. Like I would be saying that I want to enter as close, as soon as I see this push up and it coming back down, I want to enter as close to this line as possible. Because I believe that to be the line of the bears that we are hammering at that point. Bears shorts covering differs from new FOMO chasers. How to differentiate? Thanks. I mean, it's both, right? So like there can be new FOMO chasers who are now buying into the stock, and the bears covering can also add momentum to the play. I don't know that there's a way to differentiate between the two. All that matters though is that they're both playing for your side, right? New FOMO chasers and bears covering. The way you ascertain that they're maybe bears covering is by paying attention to things like this. Things like supply and demand, first of all, and then things like reaction candles as big bear add positions. That tells you that you've probably got some bears in here that you are trapping or squeezing to some degree. Yeah, like Callum said, you don't differentiate. It's just buyers. Whoever's buying is buying, and that's all that matters. But the way you can kind of tip yourself off as to whether you're dealing with bears as buyers is by applying things like supply and demand, and by James' reaction candle system is a good way as well. And I'm sure there are even other ways. So resistance, yeah, it is at its most basic. Yes.
So what do you have a different strategy or take on so reactionary candles? You're not sure, but you're assuming that they're short starting a position versus just people organically profit taking or taking profits at a certain point?
Yes. Because this kind of volume to me is coming like a
profit taking from normal.
Yeah, precisely. Okay. Like this kind of volume on this kind of stuff is typically to me saying that somebody has an interest in shorting it, because that's a big move given. Well, I mean, that's kind of the basis of the candles, right? So like we said, we have the relative movement of the stock, the normal movement of the stock when there are just normal things happening. The average buying and selling of the stock has this normal movement, but then when you get this, that's not normal movement. That's not normal for the stock. So if this candle isn't typical of the stock, why would I want the explanation for this candle to be typical? This candle is outstanding, and therefore it must or could very well have an outstanding reason rather than just kind of being the normal motion.
And the smaller candle after that large reactionary candle, you drew a line there.
Yes.
I know why you did that.
Yeah, so like when we talk about James likes
shows that small candle, what does it indicate there?
Yeah, so like James talks about how like a lot of these bearish ads happen in threes. And I have found that to be true not only on like the macro structure of like if you're looking at this price movement, for example, you see bears start entering here, and then you see them start entering here by this candle. So you see them entering here, A, by just price rejecting and refusing to go higher here, but B, by this. Then you see them entering here for the second time, and then here's their third entry, right? But it doesn't just happen on the macro scale like that. It also happens on the micro scale. So to me, there are bears entering at each of these positions, because what you get, kind of like when you get a sharp bullish movement, right? We talk about FOMO chasers. It was something that somebody just asked about. You get FOMO chasers as bears too, and you get amateur bears too. So like, whereas maybe your more highbrow bears are entering consistently based on their macro trend of 1 bear ad, 2 bear ad, 3 bear ad, more amateur bears or FOMO bears are adding on the back end of that work that the better bears have done. So for me, when we talk about bears moving in threes, I see that on the micro trend as well. So this would be 3 bear ads to me. So for me, you could also just draw one like this and say that this is bear ad position number 3. These are your real amateurs here that are piling in, trying to FOMO chase this thing lower. And as soon as you crack this, you see that you get a pretty good movement on the buying side. So some of these guys are probably covering because they realize that they're stupid. And then what you get here is it cracks this one, and I want to see it hold this one to make a push up to this level. That's why typically when I'm playing like this kind of microstructure, I want to see it hold bear ad number 2, and then my first take profit is, and I take 50% of my position off at bear ad number 3. Because bear ad number 3 could absolutely just reject, and if it just rejects, then it's probably going to be another slam downward because bear sentiment is still in control. And so I look at this line as the second bear ad on the microstructure, and therefore I want to add as close to this level as I can if I see it hold this level for a play up to this level and then potentially this level, which was the second bear ad on the large on the macro structure. So
wow, that makes a fuckload of sense, and thank you. And this after the second bear ad, are those bears covering there, or?
Yeah, that would be that is the theory, right? Nobody can say for sure, but that is
Yeah,
the
but
thought.
that's them covering and shorting it, trying to push the price back down, and then they fail.
Yeah, these people are still in profit, right, from this ad. So they want to keep pushing price down from here because they want to keep making money. These people are underwater, so some of them want to cover. Some of them are still believing in the trade. Ultimately, they think that it will come back short again because it is still below this, which is why when you get above this is when you would expect, which is why when in general, when you get above the third bear area appreciably is when you expect a bigger move, because now anyone who's still in this trade from here and here and here who thought like, oh, it's going to get rejected and come back down and then I'll be in the profit, they now know they are fucked. And so now that they know they are fucked, they are rushing to cover. And when they rush to cover, they
psychological squeeze.
Yeah, pretty much. Like it's a game of
squeeze. Okay.
It's a game of psychology, and it's why we preach using stop losses so that you never end up like one of these idiots who inevitably held because they thought it would get rejected here and go lower, and then they ended up underwater from $15 to like somewhere around 17 because they refused to get out thinking it'd get rejected from here, and then they just ended up having to buy in to cover their position with all the buyers that were trying to push price higher anyway.
It could have gotten rejected there, though, right?
Yeah, it could have. It certainly could have. That is very much the thought, is that from a short perspective, they want to hold this line, and they gave it a little bit of an effort. Obviously, like there was a little bit of shorting still happening, but ultimately buyers got the push, and once buyers got the push, they're all underwater. But you have to kind of think like the people that are right here are not as underwater as the people here. And so like there's a certain point at which like, are you willing to be underwater from 1550 to 1650 for the chance at a rejection that will ultimately take you green? Or would you rather just have a stop loss that takes you out of the trade after a minimal loss, and then you can decide to re-enter the trade if it does get rejected and ultimately goes your way? Like I'd rather just get stopped out and choose to re-enter if the trade ultimately does start going my way, rather than hope that it gets held and end up getting squeezed in some instances, because that's going to be a big loss for some people. Like this is the 1 minute chart, so prices once you get here, especially, prices are really moving. So some of these people will end up taking some pretty hefty losses in that move, which is not worth it in my opinion. Whew.
Awesome, man. Thank you. That made a lot of sense.
Yeah, of course. Let's see.
Did you see anything interesting on SBRT as far as bears and bulls fighting?
SPRT. SPRT is
eventful.
Yeah, SPRT was a big runner. Honestly, like this was just a slaughter. I'm like, this is just bulls slaughtering whatever bears were here over and over and over and over.
Beautiful disaster.
But like, yeah, this thing was like a nightmare. But for bears, because it really just, I mean, it had no breaks basically. But I mean, even here you can see like bears added a position here. They took it very low. And then as you came back up to this area, which is also a supply zone, given its results, bears tried to fight it off, even tried to fight it off there where it almost got above them. And then once you passed by it, these bears start realizing that they don't have the juice. And once they realize that they don't have the juice, as you can see in the volume, like look at this buying volume that pushed up again, and then look at the selling volume. It almost immediately just dies out. There's no sellers here. And when there are no sellers here and it's supply turning demand, there are going to be buyers. And there it goes. And you could even extend that zone out and see it as the origin of this, which is probably what I had at one point, and I just redrew it from here to here just to make it cleaner. But yeah, you can absolutely see bears and bulls just kind of fighting at different areas, and you can see them by supply and demand. You can see them by reaction candles as well. I mean, look at that, bang! There's the move because they're underwater.
Golf, why did you do it again on top of that reactionary candle on that last one? This is pretty small. I mean, I wouldn't. So it's like a relative to the size of the other candles, right? It's not necessarily the biggest candle. It's one that's bigger than the rest of them.
Yeah. So this is what I mean when I say that after a while you start seeing the 5 on the 1 and things like that. I'm doing that because on the 5 minute, that's just all going to be, where were we? We were right here. On the 5 minute, this is all just going to be one big candle. And so like, I'm just looking at it and saying, okay, that's one big bearish move on the 5. And
so is 5 a very critical time frame for this theory or this method?
I think the 5 is just most people's preferred time,
less noisy,
or for the for intraday trading. I prefer the 1, but I tend to be the exception in that case and not the rule. Most people seem to prefer the 5, and so sometimes I will sit there, and I think part of the reason I prefer the 1 is because I can deal with the 1 and know what I'm seeing on the 5, even though I'm looking at the 1. And so for me, that's probably why I will end up marking candles that sort of way and dealing with them that sort of way, is because for me, it's all kind of running together as information, not really like not tied down by a time frame. But yeah, so most people use the 5. I just use the 1, but I know that on the 5, this is just one big bearish movement. So that is why I mark the top of that, because it is the top of one bear ad on the 5, which is fine. But you could also, I mean, for what it's worth, you could also mark this one. It's just as effective, right? Like this one almost comes down to there, and you can see here gets touches. So no matter which one you choose, really can't go wrong in this case, because you could either do it based on the 1 or based on the 5, and either one's going to be a pretty good approximation of where the bears are and what they're doing. So
I see. Do those supply and demand zones there help you when SPRT seemed that it was making newer all-time highs? So I see those supply and demand zones that you drew there.
Yeah.
Did they help you at all?
No, because obviously price never really came back to them. What they do help with, like here, so I mean, some of them do, right? So, like, see, oh no, I would have drawn this one just based off that. So, some of them do. So, like this one, obviously, when price came past and I marked the top of the James candle, you could take an entry right there where supply is turning demand, and obviously you get like a massive rip there for like $6 or $7. And then you could draw other ones. I mean, you could draw one here pretty good, and you'd see that it would play out over here from 26 over to 30. Oh, didn't mean to move that. All right, there we go. You can see if you drew one here, it'd get rejected there. Like there's, yeah, there's a lot. Oh yeah, this one was from 2004. This is from the daily on 2004 because I can't go back that far on any other timeline except the daily, weekly, and monthly. And you can see that obviously like played out really well a couple of times to the tune of like let's see, when it did it here, it went from 30 to 55. When it came back and bounced, it went from 31 to 42. When it came back and bounced, it ultimately went from 31 to 59. Yeah, 59, almost $60. So, and then when it came back, you can see it fought here a little bit. And then when it got below it, look at that. That's that James candle from all the way over here.
Yeah.
And you can see that like when price came back, it was hitting this line almost perfectly and couldn't break it again. So, sign that bullish sentiment is well and truly in control.
Bullish or bearish?
Bearish, excuse me. Thank you. Can you please add mRNA to the list? Go through at the end if there's time left. Yeah, I'll look at mRNA. And then I had some other tickers, I think, from you that you want me to look at. Do you want me to look at this on the daily, or like what time frame do you want me to? Because this looks like it's going to be a daily type thing. Learning to invest. You just let me know. It's a large cap. Oh yeah, it's Moderna. Daily, yeah. All right, sure. Bang, bang, bang. Where's the price? There it is. Ooh, what you doing? Look at this little guy. Well, it's at all-time highs, so that's first of all. First things first, it's at all-time highs, so there's not really a whole bunch of zones to be drawn, but you can draw this one overhead. Actually, I'll just go ahead and make it that wide for now, and then we'll slim it down. So draw that overhead, and then kind of take a look at where you actually want to put the move. So I would probably put this right here for now. Then we'll go down to the 15. And let's see.
Check out that 350 level demand zone.
350 level demand zone. Yeah, right here. Maybe.
I tested on that wick, like a nice little wick down.
Yeah, let me draw this boy. So, trading view. Aha. Yes.
Money
right there for sure. Thank you for that shout out right there. Because I was just looking at this zone. So you can look at this as a zone, and ultimately this is a zone as well, obviously. Probably just draw that like so. We'll go ahead and change the color of this one to demand. Boop, boop. And I'm sure we can get back to them on the 5 because they're really not that far. So let's just make sure.
I'm so sorry, I lost the screen for like 30 seconds. So you went back to the 5-minute time frame, and you found a reactionary candle and just continued the zone?
Oh, for like these zones that I'm making right now?
Yeah, yeah.
So I started at the daily, and
I'm so sorry, man.
no, you're good. You're good. You're good. You're good. It's no problem. You're good. So I started at the daily, and what initially started out as was kind of this zone, because I see that that's kind of a heavy reaction area. And then I popped down to the hourly and zoomed in on the zones here and here. And then Caden pointed this one out. And then I popped down to the 15 and just kind of narrowed them, because that's kind of the process of kind of going in and kind of getting them where you want them to be and how you want them to look, and exactly how wide you want them, and et cetera, et cetera. So like this one's actually going to end up, no, I did this on purpose. I want it to be like that. And then you go down to the 5 and you can check it out one more time. Make sure you're satisfied with the level where it is. So that for me is that level. This for me needs to be just a touch higher. All right. And then, yep, this one just a touch higher as well. And ultimately, these would be the levels that I'd be watching as Moderna develops. And you can see, like Caden said, that this came down, and this level from back here, it came down and tested right here at 364, 365. And what can you notice here, by the way, folks, except massive bullish RSI divergence. And so these would have been pretty damn good ads. 364, it ultimately runs to like 384, all in the span of one morning on August 20th. Would have been a master class of ads. I don't know if you can play options in pre-market. I wish you could.
It made a divergence because the RSI has the chart has. It's weird. So in my mind, the RSI divergence is when the chart has a higher high and a higher low, but the RSI shows something else. It has a lower low, for example. Let's say.
Yeah, so that's bearish divergence on the RSI. There's also bullish divergence. So bearish divergence is as you describe, when price is going up but the RSI is going down. So for example, this is kind of a show of it. So like price is going a little bit up here, but you can see that there's divergence because RSI is going down.
That's bearish.
It can, yes, that's bearish divergence. It can be the same when like price is going up and the RSI is flat. If the RSI is flat and price is going up, that's bearish divergence. So it is with bullish divergence. If price is going down but the RSI is going up, that's bullish divergence. And if price is going sideways, yeah, if price is flat but the RSI is going up, you're getting stronger and stronger, and so you're expecting it to go up. And so like it goes both ways. You need to look for how the RSI should be in sync with the price action, and if it's not in sync, then there is a divergence of some kind, and it's just about defining what that divergence is. So for instance, you could consider this price action flat, but the RSI is going down, so that's bearish divergence.
But then the price went up later.
It did go up later, but in the meantime, it really just kind of like didn't do anything. Like this is a long time before it finally went up. It's not always a sign. I mean, no system is perfect either. So like it's not always a sign that stuff will go up or down. It's just another sign. It's another tool in your toolbox. I mean, for example, like here you get bullish divergence on this kind of flat motion, and there's your pop. And then right here, it's kind of flat again, but bullish divergence and pop. And so it's just another sign of things that could be happening. Here you've got flat motion, and yet it starts bearish divergence. And right as it does that, bang, there it goes. So
are those candles reactionary candles or just organic profit taking? That looks to me, because on a 5 minute you're seeing
Yeah, no, these would be reactionary to me, because the rest of the motion looks pretty tight and small. So like things like that, and these, and this one, and even this one, and all of that are a reaction to me. And so like if you just want to take a random one and whoop, you can kind of see how that line gets respected from both sides. Then once it crosses that line, finds its way. But even if you continue, didn't mean to do that. Gotta keep it straight. You can see that this line is kind of like a good line for it. Good line for what's going on. What is this tool doing? All right, there we go. So line goes ad infinitum. But yeah, so you can take the reactive candles and just kind of go with them and see where they go, see where they lead, see what they cap off. Here's a pretty good one that plays out. Can't get over that line. Can't get over this bear ad. So what's going to happen? Bears are going to take over. It's good. Okay.
So the bears added there, and when it came to that line again, they took over again and they pushed it lower, right?
Yeah, they're just adding to their position over and over. And so when they're adding to their position, you've let them add to their position once. Well, you let them start their position, then you let them add once, twice, 3 times, 4 times, 5 times. Guess what? They're ready to take profits now. So flush. And now they'll start kind of slowly taking their profits.
They were ready to take profits there at that line.
Yeah, that would be the idea, is that you've given them so many opportunities to add on these quote unquote dips from the bearish side. And now they're ready to shove price down in a big motion and then start taking profits.
Okay, so that's their break-even line. They're not taking profits there. They're going to take profits.
Right. This is their break-even line. So they get profits as price goes lower. And so they want price to go lower so that they can make money. Let's see. Okay, can you review the bulls versus bear theory for big? Final hour was epic. Oh my God, no. Bianca, go. I forgot about it. Why didn't you say something? Bianca, ask the question.
Oh, okay. Oh, no, I just didn't want to take up anybody's time, but it was just to add on to Lotus's question when she had asked with respect to supply and demand on how you need to have some form of volume there. So let's just say, for example, and of course, I'm not pumping stock or anything, but if we're anticipating movements for stocks due to catalysts, which are going to bring in volume, with respect to using supply and demand on the daily, looking at, for example, how you've been looking back at least like 10 plus years. So like Pola, for example, POLA, not pumping it, okay? Like Tyson up, like we're all excited. Goggle Gang's excited, MCA Goggle. But anyway, but with this Category 4 hurricane with potential to becoming a Category 5, this puppy, if you were to pull up the chart back in January 19th to January 21, so Thursday or Friday, serious fucking pump from orders due to the climate change that Biden had put out. And I know I was discussing this on Voice yesterday. I mean, we have very high conviction in this play, but the volume really didn't come in. I mean, I know there was some slappage after hours, but nothing to write home about. Yeah. So marking your supply demand zones or using the reactive candles on this. And then just to anticipate the zones that you're looking for, come Monday, for example, or Tuesday.
Yeah, sure. So,
because you know me, like I like to be there before the storm. So yeah.
So this is probably a good zone in here somewhere.
And shout out to Tyson again for reminding us on that play, keeping tabs on the hurricane PR.
I'll just mark like the first 4 that I see overhead as sort of zones. I
appreciate it, by the way. Thank you.
Yeah, of course, because I don't want to speculate like too far. Let's
Which
see.
is understandable. I mean, I get it.
Yeah, and then this one's just the bottom of this zone, but I'll mark it for easy sakes anyway. Yes. That's fine, and then we'll go down to the 1 hour. Bop, bop, bop.
Did my question make sense? I know
Yes,
sometimes-
it did.
Okay,
It did.
perfect.
It made sense.
Thanks.
Let's see, tighten that up a little bit. And then where are you? All right, so this zone should actually be right here. Which is fine. All right, and then all right, let's do this. All right, and then we'll go down to the 15. This will be good for people anyway because they just get to see this process again and what I'm doing. So whoop, let's tighten it a little bit. Actually, maybe right there.
Kind of why you did that one?
Why I did this one?
Yeah.
Yeah, because most of the like consolidation in this range is in this box, and because I see this big volume kind of happening on this day, right ahead of when this big bearish move kind of formulated. So I'm seeing some really solid volume here, and then seeing a lot of movement in this little range here right before the flush, right there. So that
What day was that? I'm sorry, I'm just looking. I'm
Oh
trying to
yeah, you're good.
keep up. I'm making coffee too. I'm watching.
August 10th into August 11th. Let's see.
Oh, would you take it January's run up into account, or is that just an outlier?
I may take it. I just need to. I want to do these recent zones first, and then I'll look at how the January run up kind of squares with those, if that makes sense.
Oh, for sure, totes.
Because it looks like there's already been a lot of price run through of January's run, so like I wouldn't necessarily expect a lot of those zones to still be fresh and active, whereas these zones have not been run through at all, and so they should be a little more fresh, a little more active. That's what I want.
So just a simple question. So as far as marking your zones on the daily, you include the wicks in addition to the bodies.
Go ahead. Yeah, if they're in the kind of in the consolidation range, yeah. Like you see that when I like get up here and actually see where stuff's kind of consolidating, I change the zone a little bit.
Okay, I see what you're doing.
Sort of where the box is. If there's just one wick that's way outside of the box, then I don't really care about that wick so much. Like this wick is just way out of hand, so I don't really need all that. Kind of want it right.
Why don't you need it?
This wick?
Yeah.
Because it's just not really like, it doesn't square with where a lot of the other volume is. Like the other volume is all kind of captured in this range, whereas like this is just kind of meh. This is just up here, like it's in no man's land, and price has not really come back anywhere near to that. Whereas like price has come back to this zone, kind of lower to where this volume was closer by. So that's kind of how I'm operating in that sense, I suppose. I kind of fight with zones like this because I don't know whether I really want them to encapsulate this or not. Ultimately do square with those and let them keep it. And so then we'll pop out to the daily. So those are the zones that I see ahead of time that are fresh zones, I suppose. And then, yeah, the January run up is going to go all through this, except this is obviously going to be, so I'm going to go ahead and mark this because this is going to have been a big kind of demand pop. Could really be a little bit below that, but I just want to see. So first of all, I want the stack.
Chart is just
Man,
sexy chart.
1 hour. Boop, boop. All right, let's see. Let's see. Where do I want this? Yeah, this range is fine. So then I'm gonna. Well, I actually kind of want it up here because this is where the big run kind of happens. So I'm okay with that. That's the box. Lower it just a tad. Okay. 15. Whoop. See if we can go back that far. We can, but I'm nervous about the 5 on this one.
I was just thinking because in that run up, people are bag holding. They're stuck up there.
100%. All right, so then that's what I want. We'll see if I can get back on the 5. I can't go that far back on the 5, so we're kind of stuck with whatever. Oh, don't do that. All right, we're stuck with whatever the 15 gives us. So, if you go out to the daily, then you can actually see it's actually pretty fucking clean.
Beautiful.
It's pretty fucking clean.
Sure, then people are turned on here.
That's actually pretty fucking clean, to be honest. But yeah, so and you could have taken an entry here off the same reasons that I'm talking about earlier. Like, look where the RSI is when price is around here, and then look where it is on this right shoulder. And so you could have taken an entry just off RSI divergence there and made a nice little play. You can see that it's already kind of battling this level right here. So it'll have some trouble with this, and then after it clears kind of the 760s to 780s, I'd anticipate like 880s. You could have something in this candle, to be honest, but like that's so close to this that I assume that the momentum ripping off this won't care about this.
Hey, you just mentioned there was a RSI divergence somewhere in there. Could you point that out or explain that a little bit?
Yeah, of course. So this is why it's harder to see on the daily, but it's there nonetheless. So for example, look at price at like these levels and price at these levels, which are basically equal. I mean, realistically, I could draw these lines anywhere here, and that is price at these levels. But look at the RSI here. I don't know why this pops up, so I'm so sorry that is blocking. So look at price where it is here, and look at the RSI, and then look at price where it is here, roughly equal, but the RSI is way, way up there.
Got it. Okay, yeah, I totally see that. Thanks.
So it's bullish divergence, and what I would tell you is that on a lower time frame, this probably fleshes out to be a head and shoulders, like an inverse head and shoulders. And so like what you've got there is the inverse head and shoulders RSI divergence play strategy that I was talking about. And look, if you draw that James line, it's basically a perfect touch. And so like, yeah, if you zoom down a little bit, you can see a little bit more clearly that what you've actually got here, even though it's still messy because it's just a mess. Where's my tool? Where I'm still learning this. There we go. Brush. Whoop. 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 And it then that's your inverse head and shoulders, where the right shoulder had massive divergence from the left shoulder, which is just nice to see. So, because like you look at price all around here, RSI is down, pull it up, RSI is down here, then price equal level, but RSI is way up here. So you can take an entry here and probably put your stop loss. I'd put it like right here. Bang.
You didn't mark any reaction candles for the bears to look at, right? I mean, if let's say if you were, I mean.
Yeah, I mean, if you wanted to do that on the like right here, for example, you could say like this could be the key line in this zone, right there around 774. You could also mark this one and just say above the zone right there at $8. But I know that $8 is a psych anyway.
Oh, I thought you were marking below green candles for bears. I mean, am I getting that wrong?
The top of reds. The top of reds.
For bears, I mean, like, okay.
Yeah, well,
right.
for bear ads, and it's for when you're looking for bullish moves up, you want to see them cross those lines.
Okay, no, I'm just saying if you were a bear, like to look at.
Oh yeah, if you were a bear,
crack.
So yeah, same principle in reverse. So yeah, the bottom of green, bull ads would be what you're looking for bears, and you can see how that works out here.
Perfect.
So yeah, you could definitely look at it that way. If you were trying to play like bearish, you could look at it in reverse. But
thank you.
Okay, I know that Rogue is getting ready to go, which means we will no longer have our friend for what is it? Videoing it, recording it, and so we are pretty much out of time, I guess, because I don't want to like do too much content that isn't recorded. So. Any final questions? Anybody with any last sort of things they want to ask?
Could you just send me a screenshot of that? It'd be great, so I could study it. Thanks.
Oh, of course, yeah.
Thanks.
Do you want it like on the daily?
Sure.
Okay.
Thank you.
Yeah, sure. And then just condense it. You know what, Bianca? Just tell me what you want it to look like, because otherwise my picture may be different. Like
no, it's cool. Just send me the daily so I can mark the zones on my chart and practice that way. Thank you.
Cool. Save chart image. Let's see, copy.
I'll just DM you a screenshot later of what I have to see if it lines up with what you have, and
paste.
I appreciate it.
Yep, there you go. You should have it.
Rogue goggles. Thanks for
yes,
for recording this.
I forgot that Eslo asked about big to see the bears versus bulls. Yeah, so so you can see with supply and demand what was kind of happening here. So if you want to mark that, you can, but really this is going to be the start of that position. So then when you got over it, they very quickly obviously decided that the momentum was too much and it rushed. Those are probably coming from the 1 minute. It's probably why those lines are there. But see here that we're over this bearish ad zone, or if you want to go from the top of what would essentially be like a 15-minute. We were fighting for this, and then we got done fighting for this right about the time that after hours ended. But you can see a good push came out of finally conquering this. So bears versus bulls in so many ways for big. It was just kind of a comes up to the zone, fights it. Where's the zone from? This may have been a great example of like zones from earlier on. Yeah, look where the zones from big come from. Like they come from days and days earlier sometimes. And so it comes up to the zone, fights the zone, conquers it, retests it as demand, bang, fighting the zone, fights through it, retests its demand, bang. Gets up on momentum here and then gets flushed back through both of these, and then comes back through this one. This is no longer really a zone at this point because we've obviously well and truly like filled this shit at this point. And so this is just fighting through.
Which one's on the zone again?
What's that? This one, because like you can see we've kind of cut through it. Like it obviously fought when it came up to this zone here, but then when it came to the zone here, it really just kind of smoothly moved downward through it. And then came up and we claimed this bear ad, which sent us up to this bear ad where it got rejected. And we still had some consolidation here. We finally cleared it. And once we got above it, they joined us. Went up through, fought this zone, then got a big move through it, retest as demand, back up to this bear ad where it kind of fights around for a while, and then finally claim this bear ad, and then got your last big move. So that would be the fight all day long for BBIG. which was fascinating. And I mean, if you want to get really whatever, like if you're looking at the 15-minute, like this bear ad, and this bear ad was something that it kind of fought away from initially, and then once it claimed it, got the move, bang, etc., etc. It all comes back to the bulls and the bears, and the birds and the bees, the bulls and the bears. All right, y'all. I think that's it. I think it's a solid Saturday morning session. Sorry that I'm long-winded as always, but thank y'all for joining me for the past 2 hours.
Awesome, Bob.
I hope you learned something. I hope you got something. Thank you. It's nothing special. I just have fun. So
Thank you so much.
yeah,
It was great.
You rock.
Jeff has fun.
I don't know about that. This is just fun for me. So yeah, hope y'all learned something. Hope y'all got something out of it. I hope that I broke it down well enough. Always feel free to tell me if I didn't break something down well enough for you, and I'm happy to like meet with you separately and like try and get it more clear for you, because I don't want to leave anybody. The whole point of me doing this is to not leave people mystified by anything. Like I want to kind of give you what I see as best I can.